details just slightly later. The yen, though, currently at 148.80 versus the USD. It is higher versus the US currency. Our other top story, President Trump's 25% tariff for India, as well as South Korea's trade deal with a 15% rate and promises of hundreds of billions of dollars of investment in the U.S. Now, just a day away from the August 1st deadline, nations are running out of time to get their deals across the finish line. Live from Singapore, this is Insight with Haslinda Amin, where we dive deeper into the stories that matter with crucial context and sharp analysis. We'll get reaction to the latest trade twists and turns with our expert panel. JP Morgan's Global Research Chair, Chang, joining us along with former U.S. Assistant Secretary of State, Biswal.
Higher tariffs have begun to show through more clearly to prices of some goods, but their overall effects on economic activity and inflation remain to be seen. Basically, this was quite a good meeting all around the table. We have made no decisions about September. We don't do that in advance.
The Fed noting inflation risks as it holds rates with two dissenters voting for a cut. Jay Powell unnerving traders by steering clear of signaling easing in September. Straight to our top story, President Trump ramping up his tariff threats and securing more trade deals ahead of his self-imposed Friday deadline. But before we get to those details, let's take a check on how the yen is trading on the back of the BOJ's standing pat as expected. The BOJ saying that it is set to raise rate if the economy and the price outlook is realized. Currently, of course, the yen is the first one to react to the BOJ standing pat and to the statements out of the BOJ. It is trading versus the USD currently higher by 0.5%. The BOJ again standing pat on its rate. Of course, traders have been waiting for signals on whether or not there is any sign that the BOJ will make a move anytime soon. Let's do a check on our top story at this point in time. President Trump ramping up his tariff threats and securing more trade deals ahead of his self-imposed Friday deadline. Trump has turned up the heat on India, saying he'll impose at least a 25% levy on their exports to the U.S. as the two countries struggle to agree on a deal. And that could go higher as punishment for Russian energy purchases. Even a 25% rate dashes New Delhi's hope of preferential treatment over its Asian peers who secured tariffs ranging from 15 to 20%. Now, among those who got a 15% levy is South Korea. Like its regional rival, Japan, Seoul also secured a deal after agreeing to massive U.S. investments, this time with a $350 billion fund.
Korea, as you know well, has always been very challenging on trade for the United States. We've had an agreement with them in past years, but our trade deficit with Korea has continued to be extensive. However, President Trump has raised the natural leverage of the U.S. market to really obtain some significant concessions from the Koreans.
Well, for more on both these trade fronts, let's bring in Seoul Bureau Editor Danny Thomas. Our South Asia Economy Editor Ruchi Bhatia also joins us live from New Delhi. Ruchi, let's start with you. Quite a huge disappointment for India.
Oh, absolutely a big disappointment coming in for India. But, you know, the feelers that we had gotten from New Delhi was that it did look like that the August 1st deadline was very hard to meet, which means that now the Indian government will look forward to getting a deal in place by the fall of this year, which was the original deadline. Having said that, a 25% tariff plus an undefined penalty because of India's relations with Russia, the fact that India buys a lot of oil and weapons from Russia, Russia makes it very, very tough for the South Asian nation. Now, also remember, this puts India at a significant disadvantage to some of the other Asian peers, like Japan, for example, that got a 15% tariff rate, and other countries like Indonesia and Vietnam at 19 and 20%. So clearly, the Indian government at this point of time saying that there are certain red lines that they're not willing to cross. This is something that the Indian government has been saying for a very long time, that giving unprecedented access or greater market access for agriculture and dairy sector as well as GM crops will be red lines that the Indian government will not look to breach. And now it really boils down for us to see as to where things are headed from here on. A trade delegation is expected to visit from the US to India by the 25th of August. Probably they will take the conversations forward. But the fact that India has seen this big penalty coming in because of its relations and historically very strong and stable relations with Russia is something that has definitely come as a big shock.
Ruchi, thank you so much for that. Let's get to Danny. Danny, South Korea getting quite a good number, 15%, among the lowest in Asia.
Yeah, Haslinda, this is a completely different story in this part of the world. South Korea, as you know, started a bit late because of the whole political turmoil here, and negotiations only got underway in earnest early June when the new government took over. And since then, they've been trying at their best, and it was a touch and go, but finally we got to a stage where we got a deal which is pretty similar to what Japan agreed to, and I think that's a pretty important milestone for South Korea. The 15% is also for autos. That was also a pretty touchy issue because almost a quarter of the South Korean exports to US is auto. So that's a big win as well. That apart, the other highlights, as you mentioned, is the $350 billion investment in US. Details are not known, but that's something, as we move forward, we'll get to know what exactly that entails. There is a $100 billion commitment to buy LNG from US. That's also along the lines what some other countries have agreed. But I think what South Korea has dodged in a way is that they haven't caved into the demand of opening up the farm sector even more. That was a pretty politically sensitive issue here. Farmers were already agitating against it, and President Lee himself intervened, and he made that kind of a red line. And that was a big win and a big coup for South Korea and the new president. I think what's still not known, there are two key unknowns here. One, Forex could be an issue, and there are talks underway between the officials that may give us some more sense of where that is headed. And the other big question and the big unknown is whether US will have or will try to impose something more on the defense side of things. There has been demand for South Korea to increase defense spending, and also there has been kind of discussion and rumblings around whether more need to be spent for hosting the US troops in the South Korean soil.
Danny, thank you so much for that. Seoul Bureau Editor Danny Thomas there. Let's get insights from our panel of guests. Joyce Chang is Chair of Global Research at JP Morgan. Also joining us is Nisha Biswal, partner at the Asia Group. She's also a former U.S. Assistant Secretary of State for South and Central Asian Affairs. Joyce, let's start with you. When it comes to Asian markets, they're in a negative right now. Not surprising. We're getting more clarity when it comes to those tariff levels. I'm just wondering how you're assessing the impact on global markets. When you take a look at the tariff for the U.S., it's actually inching higher to 18 to 20%.
No, I would just emphasize that the worst of the near-term effects of higher tariffs are still ahead of us, not behind us. So I think there's reasons for the market to be cautious here. On the tariffs, 15% is the new 10%. If you look at the deals that have been reached so far, you have a general tariff rate that's now 15% for Japan, Korea, the EU, and we thought it would be a 20% ceiling on ASEAN, but what we're seeing in India is that what they're talking about, 25%, is very close to the 26% reciprocal rates that were announced on Liberation Day. So look, I would just point out that this is a big tax increase. The tariff had been running in the month of June at around 10%, so going up to 18 to 20% will be a big hit. We've had a lot of front loading, and the hard data and also the earnings data has been very strong off of the front loading. I think some of these effects may not play out until the fourth quarter of the year, but I would just caution that the worst of the near-term effects of the higher tariffs are ahead of us, not behind us at this stage.
So given that the worst is yet to come, Joyce, should you be chasing this rally risk reward, what should you be doing?
So I would take a more cautious stance in the portfolio. We would look at some hedges against either a deterioration of the macro data or, just really looking at, higher for longer. I think the main game in town is not about the Fed right now. So we've been talking about some macro hedges like long S&P 500 put spreads, long VIX call spreads, in the equity markets. I think that, right now, the Mag 7, though, is holding in very well. When you look at the earnings that have come out for the Mag 7, we've been looking at 14% EPS, in the second quarter compared to 1% for the rest of the S&P 500. So we have some strengths here that are still coming from, the data center story, from the AI story. But there's reasons for caution here, given that these negotiations are still ongoing, and an 18 to 20% tariff rate. I mean, we were at 2.5% at the beginning of the year.
Nisha, let's get you into the conversation. When it comes to South Asia, the countries have been hit hard. We've seen tariffs ranging from 20 to 46%. I mean, you can't say that the U.S., Trump in particular, has played hardball.
Yes, indeed. And I think, what has been surprising is that with India, the negotiations had been going quite well. And we were hearing as early as just a couple of weeks ago from senior levels of the Trump administration that they felt confident that they had unprecedented concessions coming from India. So, and we had been hearing from the Indian side as well that they thought that they had been close to reaching a phase one deal with the Trump administration. So for now, for the president to come in with a very hardball tactic of announcing 25% tariffs as well as penalties for Russian oil and gas imports, et cetera, I think is a little bit surprising, and certainly to our Indian friends, they're kind of shocked because they thought that they were working in good faith and were close to having a deal.
What went wrong, Nisha? What do you think went wrong? I mean, we talk about how, Trump has acknowledged Modi, for instance, as a good friend.
Well, first of all, I think that President Trump wanted more concessions on ag and on dairy and on GMO, as you noted. And those were concessions that, frankly, India is just not in a position to make at this time. From their perspective, it's politically extremely sensitive for their farmers and dairy culturally. On the other hand, we had also been hearing that the president wanted to maintain a 20% tariff rate for India. And that also was a non-starter for the Indians, particularly when 15% rates had been announced in the agreement with Japan, with the EU, and now with South Korea. So I think the Indians, had been negotiating for a tariff rate that was going to come in around 13% and had agreed to bring down their own tariffs down to zero in many, many sectors. So I think all of that now hangs in the balance. And the question is, what is the next step? Is the next step going to be India retaliating, or will they continue to negotiate in good faith and work towards a tariff deal, perhaps not by August 1, but hopefully by the fall?
Joyce, how are you assessing the prospects for Asian markets? I mean, it does look like Korea, which is a winner with 15%, could be leading the rally in Asia, and India could possibly get hit.
Well, I think you also have to look at the rest of the world. I mean, we're looking at 50% for Brazil. We're still looking at 30% for Canada, and at 30%, 35% for Canada and Mexico. So yes, it is a better than feared outcome in Asia when you compare it to some other parts of the world. I think all attention is going to focus next, though, on what's going on with China, because you've got the August 12th deadline coming up, which everyone expects to be extended. But you still have in other parts of the world outside of Asia higher tariff rates or equivalent of tariff rates that are prevailing. So I wouldn't say that Asia is necessarily faring worse than the rest of the world here. And then on top of that, we still also have to look at these 50% tariffs that are on copper, what's happening with the sector level tariffs, as well.
You talked about China and how the deadline has been extended, but China is also susceptible to the trade deals that have been struck between the U.S. and other trading partners, case in point, Vietnam, and those transshipment tax.
Yes, no, I mean, for China, the negotiations with other trading partners really matter a lot. For Vietnam, you have a much higher transshipment tariff than the general tariff at 40%, to crack down on the transshipment from China. So that's going to be negative for China. And you also have the sector-specific tariffs. So perhaps you could see some relief on the 20% fentanyl-related tariffs, but I think that the reciprocal tariffs and the product-specific tariffs, you still have more upside there. And it seems to me that on the product-specific tariffs, you're going to have much more use of the 232 investigations and some of these other institutional mechanisms that will take longer to put into place, but I think will be also much harder to remove or adjust.
Joyce, help us understand, despite the tariffs, you're overweight. In fact, you raised your call on emerging markets to overweight. Why is that? Given that the tariff levels we've seen pretty much throughout the emerging world, it's pretty high.
Well, emerging markets have had a terrible time over the last couple of years. They've lost 55% relative to developed markets since 2021. And if you take this back to 2010, this is a 200% lag to a developed market. So the valuations are very attractive. You're looking at 30 times forward PE. You're looking at developed market levels that are at 20 times. You have investor positioning that is still more attractive as well. I mean, the positioning does worry us here because the risk reward of chasing further upside in a lot of these risk assets seems very modest to us. So I think emerging markets, the overweight we moved to a couple of months ago, we think that you will have still outperformance of some of these international markets over the U.S. markets, even with the strength in the U.S. market. And I would just point out in the U.S., the very strong concentration risk that you're seeing, in AI, in data centers compared to the rest of the marketplace.
Anisha, we talked about how countries have been negotiating with the U.S. in good faith, India in particular. It is complicated, isn't it, that President Trump is not just looking at trade, but also security, strategic issues. These are playing out in these negotiations.
Indeed. Look, I think there have been tensions in the U.S.-India relationship. There have been points of friction for decades. And the legacy relationship with Russia, the import of Russian oil and gas, the defense partnership have all been things that successive administrations have had to deal with. But there's also been a recognition that there's a broad convergence, a strategic convergence between the United States and India, and that has enabled the United States to make some accommodation. Now, I think that this is a president who is perhaps less willing to make those kinds of accommodations. I think that that's going to require some recalibration between the U.S. and India as they think about where they want to go in this relationship. I would posit that both countries have too much at stake here in terms of the future economy, advanced manufacturing, the trust ecosystem, how we want to develop the technologies of the future, to go into it in such a contentious manner that there's more to be gained for the two countries to work together to achieve some kind of an agreement on trade. India is going to need to take some steps to help address the trade imbalance that the president is so concerned about. But I think that hopefully the two countries will find the way forward. It might require a conversation at the leader level to get there.
The thing is, there is one big sticking point here, and that is India's purchases of Russian oil. India has been pretty adamant, saying that it is in national interest, when it comes to buying those cheaper Russian oil. Can India maintain such a stance if it wants a better deal in terms of the trade deal and tariff deal with the U.S.?
Well, I mean, India has certainly reduced its dependence on energy imports from other countries of concern over the years. And I think that could probably be done as well with respect to Russian imports, especially as, U.S. exports to India, about a quarter of U.S. exports to India are actually in the energy sector, whether it's, U.S. crude, which has ticked up in recent years, U.S. LNG, etc. And I think that there's certainly scope for India to increase its import of U.S. energy
and Joyce,
as a means of
for central banks Joyce, when it comes to the central banks like the Fed and BOJ, this is just so complicated. It makes it difficult for them to make tweaks to the monetary policy, yes?
Yeah, I mean, look, the message, I think, from the Fed and the BOJ was that we're in wait and see mode. And we've seen that from investors at large as well. We get a lot of questions on, how much hedging has been done. And there's just been more waiting and seeing than, hedging, from what we have seen so far. But I think the Fed decision was much as expected, even including the two dissents, which had been sort of public statements that they had made beforehand. But the case for a rate cut, it would be stronger if you saw definitive signs that economic growth is rolling over. But we haven't been seeing that in the U.S. yet. And for the BOJ, I think the downward revision that the BOJ did in May was an overreaction to some of the tariff-related uncertainty. So we see that the story is, for action by the central banks later in the year. I mean, we're looking at December, if it happens, for the Fed to make a move. It could be debated more in September. And turning to the BOJ, we think they're paving the way for a rate hike in October. So I think it's wait and see mode. And again, the key story I don't think is necessarily about the Fed and about central banks. A lot of it is about the fiscal spending.
It's wait and see still as we approach August. Joyce, thank you so much for that. Joyce Chang, Chair of Global Research at JP Morgan, and Nisha Biswal, partner at the Asia Group. We'll continue the conversation on trade later on this hour. Former Indian Secretary for Commerce and Industry Ajay will be joining us with his insights. Plus, as the BOJ holds rates, Amundi Japan's Hiromi Ishihara will be sharing her outlook for the nation's equities. Keep it here with us. This is Bloomberg. Welcome back. You're watching Insight. We're counting down to the India Open, happening in about 15 minutes from here. Of course, this is the market that's seen a faltering equity market story. It's seen losses of almost $250 billion, and it is about to get even worse with those 25% tariffs imposed by Trump on Indian exports to the U.S. market. Nifty futures pointing to a flat open right now. In terms of the INR, the Indian rupee, it is currently trading lower by 0.3%. Again, India getting hit with among the highest levels of tariffs in Asia, 25% tariff versus what we saw for South Korea. It is threatening to put a lot of pressure on the Indian market. Now, let's get a look at how we're shaping up for Japan's re-entering the market after its lunch break. Of course, we saw the BOJ standing pat, keeping rates at 0.5%, but it did raise its inflation target for the year to 2.7% from 2.2%. We've seen a strengthening of the Japanese yen, in particular, higher by 0.5% versus the USD 148.82. Of course, investors have been waiting for any signals that the BOJ might just move before the end of the year. Let's get the outlook for Japanese stock markets and the yen. Bring in Hiromi Ishihara, head of equity investment at Amundi, Japan. Good to have you with us. I'm just wondering, what's your take? It's not surprising that the BOJ stood pat, but it did raise that inflation target.
So, yeah, I mean, it's the BOJ decided to hold the rate, which have no surprise, but also they raised the forecast for CPI as well as the economic outlook, which shows that their confidence that economic trend is in line with the expectations, and we do expect that another hike before the end of this year. It could be in autumn, but it's obviously depending on the political calendar, which seems to be getting busier.
It does look like Japan is an economy in need of higher rates soon. I mean, you get a sense that perhaps the BOJ is already behind the curve. Is that a fair assessment?
Well, it is, but at the same time, what we saw the market last year, last summer, precisely in August, BOJ, it preferred to be behind the curve to take, another big volatility in the market. So I assume that it is they're behind the curve, but they have, I think, it still have enough time to make to decide for another move.
You talked about the uncertainties to do with trade, to do with geopolitics, but add to that, you also have structural changes in Japan. Does it make it even more complicated for the BOJ?
It is, especially the tariff, even though we saw the agreement before the due, which was positive, however, it is still a lot of unclear elements that we need to digest in the market. So that really adds the complexity of the BOJ move, but also because of the result of the recent upper house election, we also saw the JGB market is having some pressures over the rates. So it's really adding some complexity over the decision making for BOJ.
So all eyes on the presser that Governor Ueda will be giving. What messaging are you hoping to get?
So it's really, we want to see whether we're going to see additional hike this year, or they still want to observe further clarification of the macroeconomic perspective. But I assume that it's really, according to the forecast they published this today, is showing that we are really meeting the BOJ CPI target. So the press conference is going to be interesting to see his view on that.
But from your perspective, is 2.7% inflation target justification for a move, maybe sooner rather than later?
I think it's the number is good enough to justify their decision. However, of course, the consumption side is not really strong, and the wage increase side, the real income is still hovering around the negative territory, which is also additional concern for BOJ. So I think the inflation-wise, they really have enough numbers to justify it. However, the other economic indicators might then put on hold.
What signals are you getting from Japanese corporates?
So we are heading to the earnings reporting season here in Japan, and we expect that some companies might reflect the recent tariff negotiation results. However, it will be too early to become very optimistic in terms of the earnings forecast. So it's really, I think, the overall, the current corporate earnings for this fiscal year are going to be solid and stable, but it will be too early to see the material in terms of the numbers at this stage.
Isn't it true, though, when it comes to the Japanese people, there's been growing frustration? Food inflation, rice in particular, has become quite a big issue for them. How do you see the government addressing those concerns?
Indeed, so it's really reflecting the result of the upper house election. So the people really frustrated about the inflation, and then also the lack of political actions against that. But however, as we saw that, the tariff negotiation is it's sort of, to some extent, it's now clear. So I think the corporates are now more, taking a move farther for the wage increase. So I am really optimistic on the spring wage negotiation for next year. So it's really, the time the effect base is lagging behind, but I think the macroeconomic perspective in Japan is still good shape. And then I hope that, the political decision making, even after the resignation of Prime Minister, if happens, that the overall fiscal, concern would be limited, and then, supported by the steady macroeconomic perspective.
Hiromi, taking a look at the yen, we've seen reaction from the BOJ raising its inflation rate to 2.7%. It is up about 0.5% versus the USD right now. How do you see the yen trading from here, especially if we hear a hawkish stance from Ueda?
Yeah, so I think the yen is still sort of it's more weak and depreciated trend rather than the stronger yen. And then if we see any focused tone from Governor Ueda's press conference, the yen might appreciate further. But I don't expect that the strong yen trend is not going to happening in any time soon, because I think the BOJ would take sort of neutral or a little bit more dovish tone and for the time being.
Hiromi, thank you so much for that. Hiromi Ishihara of Amundi, Japan. Of course, again, we're keeping an eye on the Indian markets, taking a look at how it might just open on the back of Trump imposing 25% tariffs on Indian exports to the U.S. Take a look at where we are right now. Pretty much the benchmarks across the board are in negative territory as we head to the India Open in about 7 minutes from here. We'll have more on the Indian markets next. Keep it here with us. This is Bloomberg. Yeah, okay. So we can do, okay. All right.
It's kind of a clampdown by the central bank early last year, so that takes its own time to get digested, and that's what the correction we are seeing. Our hope is by late Q3 or early Q4, you should see signs of urban recovery also. See, from a medium-term structural perspective, India is one of the strongest economies with low debt to GDP, strong fiscal status, etc.
Rahul Chadha, CIO at Ishihara Investment Management, speaking to us about India's economy and the Indian markets under tremendous pressure on the back of that 25% tariff imposed by the U.S. on Indian exports. We have the Sensex and the other benchmarks showing that they could be under tremendous pressure. The Sensex currently down about 1% as we speak. We know that India's stock benchmark has lagged most major global peers this year amid concerns over a slowdown in its economy as well as corporate earnings. And as we count down to the India Open, let's bring in Bloomberg's Asia equities reporter Ashutosh Joshi, who joins us from Mumbai. Ashutosh, what would 25% tariffs mean for Indian stocks, which are already battling a lean patch, trailing their peers?
Yeah, hi. The tariff announcement comes at a time when India is looking to overcome the recent underperformance, as you mentioned, but this potentially adds to India's problems, and there is a consensus that at least for a short term, India will extend this underperformance to its global peers. After years of outperforming emerging market and Asian peers, Indian stocks are trailing this year. The Sensex on a 1 year basis hasn't delivered any return. So that is a sort of worry emerging among investors. We are seeing foreign investors selling this month almost $2 billion worth of Indian equities. And with the news on tariffs, even though it's not final, there is a likelihood that this sell-off will extend at least in the near term.
You got to wonder which sectors are particularly hit and whether or not that could be beneficiaries.
Yeah, there are a number of sectors that export to India that includes automobile and related ancillary suppliers. Some of them supply to biggest American companies. They will be in focus for potential impact. Gems and jewelry companies, textile exporters, some Indian companies are biggest exporters of bed linen to US stores. So these companies, their products will potentially attract the additional levy, and these companies, their equities will be in focus for potential impact. There aren't really big winners from this. Few analysts are expecting that India's domestically focused companies, consumption especially, which is one area that has lagged in the past, may benefit because of this.
Right. Ashutosh, thank you so much for that. Bloomberg Asia equities reporter Ashutosh Joshi. Not surprising, India's opening in the red. All the benchmarks pretty much across the board are in losses as we speak on the back of the tariffs imposed by the Trump administration, 25%, among the highest in Asia. Remember, this is a market that's been already under a lot of pressure. More than $250 billion have made an exit, especially from foreign investors, and this 25% tariff will put further pressure on the markets. Let's get insights on U.S.-India trade with former Indian Secretary for Commerce and Industry, Ajay Dua. Ajay, good to have you with us. What's the sense in India? 25% tariffs, unexpected by the country.
Haslinda, thank you for having me in this talk. Certainly, there's a degree of disappointment across the board amongst the macroeconomists, in the market, currency market, both stock market as well as the currency market. And I think the degree of uncertainty left still after President Trump's announcement yesterday regarding the penalties to be imposed over and above the 25% for India buying oil from the Soviet Union, Russia now, and the large defense imports from it has added to the degree of uncertainty, and that's showing in the indicators which we just talked about.
How do you rate the chances of India negotiating with Trump, with the U.S., and getting a lower tariff rate?
I hope it happens. I'm talking as if, not as an objective commentator, but more as an Indian, because this has happened in recent times with Japan. A higher duty was imposed, but when Japan agreed to expedite the negotiations, President Trump had relented. We've also seen that happen in Philippines as well as in Indonesia, all of whom have got relief, so to say, when the duties on them are lower than the 25% imposed on India, which I think could be more like a retaliatory tariffs than long-term tariffs, which are still being negotiated. Certainly, the Indian negotiators will be under a pressure, I'm sorry, to expedite decision-making. But I do hope that it comes down from 25% and that there is no uncertainty left about the penalty because of imports from Russia. I just want to clarify one more other thing. Yes, India's imports of oil from Russia might have increased, but President Trump was not right on his facts when he said defense imports are also large. As you know, SIPRI, the Swedish Institute, has pointed out that from the earlier 72% of Indian imports coming from Russia, arms imports, now the figure between 2020 and 2024 was at half to 36%. And now we are buying much more from the US. But we have to go through it, that FMS, the foreign military scheme, where a whole lot of clearances, etc., are required from the US administration. Yet we are looking at buying the GE engines for the Indian fighter aircraft. We are looking at buying anti-tank Javelin missiles. I'm sorry. All these things are happening So I do think that President of the United States would relent and make sure that the competitiveness of India, a strategic partner.
Ajay,
Yeah.
we know that India has been a tough negotiator. Do you think that has worked against the country?
Probably. You're probably right, Haslinda. We've had, in President's mind, far too high tariffs, and we are not relenting from bringing them down, our import duties. And also, we continue to harp on certain red lines, which includes our agriculture, dairying, and now even the genetically modified seeds, particularly with respect to soy and corn, which President Trump wants to export India to buy in larger numbers. And I think yet another issue is that unlike the other countries, whether it was EU or whether it was Japan, India is not in a position to promise huge import of energy because from the US, which they would like us to do. And also, we are not in a position to talk about huge Indian investment, foreign investment taking place in the US.
Ajay, I'm just wondering whether this could be Trump's way to get Modi himself to the negotiating table.
It might well be, and I hope it is, that because we had thought that the 5 rounds of negotiations which we've had, and the 6th is scheduled for the 21st and 22nd of August in India, was on track, that India might be, India might be exempted from an imposition like what was done yesterday till such time as the bilateral trade agreement is signed partially or fully. But we've been taken by surprise. And I do hope that, one, this 25% is inclusive of the basic 10% which had been imposed across the world. And second, that the duties which Mr. Trump had imposed on steel and aluminum and the automobile industry and now generic pharmaceuticals, that those are also covered and those have also been brought down to 25% and the exceptions do not remain for them. Because we are willing to talk. I don't think if India is given an impression that we are not willing to lower duties from what President Trump yesterday termed them as obnoxious, world's highest, etc. It is 13.2%, Haslinda, average duty across the products which we export to the U.S. And certainly
Ajay,
the U.S.
As you highlighted, several sectors will be impacted: electronics, pharmaceuticals, auto parts, so on and so forth. I'm just wondering what impact this might have on the economy. How much of growth will be hurt?
You know, the first time when this 10% was imposed across the board, our rating agencies as well as the international ones had brought down India's rate of growth for the current year from projected rate of growth of 6.5% to 6.3% or 6.2%. I think another 0.2 or so cannot be ruled out if the duties continue to be at 25%, which for India, with a low base at 6%, might look, very large pace of growth. But with a small base, it does impact the country, particularly which is still very heavily populated, and the per capita income is still below $3,000 per head.
How do you think India can counter the impact from tariffs?
One, being a little more accommodating in the ongoing negotiations. Second, I think the Indian government would need to step in and make sure that the labor-intensive industries whose products we are trying to export, that there is a quicker, a faster line for exports to them, and the infrastructure, etc., which is required by them is supported. Because competitiveness is the name of the game in the export trade, as you know. And Bangladesh, probably our competitor, in textiles, apparels, has a slightly higher duty, but then it's still covered by the least developing countries definition, which the US uses, so may continue to have an advantage over us. China, Cambodia, Laos are the other countries which are competitors for us in many things, including apparel, would have
Ajay,
Yeah.
does it jeopardize India's ambition to be a manufacturing hub?
To an extent, yes, because we are banking on our exports, particularly in the labor-intensive industries of gems and jewelry, textiles. Pharmaceutical for us is also not so highly automated. Electronics, all these industries to help us move forward in manufacturing, where we've been stuck at below 15% share of the GDP for a very long time. And I'm talking about the labor-intensive industries because we do have urgent need to create employment in the formal sector. Informally, everybody is employed or underemployed, whatever one might like to call it.
Right.
The formal
Ajay?
sector, yeah.
Ajay, we have to leave it there. From our Indian Secretary of Commerce and Industry, Ajay Duwada. Still to come on Bloomberg, we get exclusive insights on the business impact of Trump's 25% India tariff with the CEO of Tata Steel. I'll also ask TV Narendra what's next for the company following a first quarter earnings beat. That is it for Insight. Keep it here with us. This is Bloomberg.